Imagine getting a 3% mortgage when everyone around you pays double that. Sounds like cheating, right? Well, before you dive into this, there's a lot you need to know. Hey everyone, Alex Knaus here, your go-to mortgage guru. Today, I'm covering a topic that was requested by one of my viewers, the Assumable Mortgage. 3% sounds like an unbelievable rate, but it isn't good as it sounds. In this video, I'll share why the seemingly perfect solution might not be as accessible as you think. We'll cover buyer challenges and provide some straightforward advice on approaching these opportunities. Make sure you watch till the end for my final verdict. So how does an Assumable Mortgage work? Let's look at an example. You make an offer to purchase a $600,000 home and the seller owes $450,000 at 3%. Your offer is accepted, but instead of applying for a new mortgage, you assume the seller's existing mortgage. For the deal to move forward, the seller's mortgage company needs to give you the green light. They'll review your creditworthiness to ensure you're a safe bet to take over their loan. Also, at the closing process, you'll need to fork over $150,000 to the seller. It's the difference between the home sales price and what is left on their mortgage. That's a lot of money. Once everything is approved and the deal is closed, the mortgage with the remaining balance of $450,000 and 3% rate is officially yours. It's important you know the terms and conditions because you're going to be assuming somebody else's loan. You're not taking out a new loan. Current rates today are around 6 or 7%, and snagging a deal like this is like finding a hidden treasure chest in your backyard. But does it seem too good to be true for a reason? Well, let's go ahead and review. These golden tickets are primarily available through loans backed by the Federal Housing Administration and the Department of Veteran Affairs. They come with a provision to allow these mortgages to be transferred over from the seller to the buyer. Sounds pretty straightforward, right? Well, not exactly. If the seller has a conventional mortgage, you can assume their mortgage. Around 70 to 75% of home loans in the US are conventional mortgages. The reality is some of these mortgage servicers processing these assumptions are not speeding up the process. Assumptions are a completely different ballgame than a new application. Mortgage companies can charge only a few $100s a piece for completing assumptions, far less than what they had earned from originating a new mortgage. This can lead to lengthy waits, poor customer service, and you find out you may get rejected at the last moment due to a clerical error. And the stakes are high. High mortgage rates today means adding hundreds, if not thousands of dollars to the monthly cost of buying a home today compared to a few years ago. For many buyers, this is a lifeline that is a way to lock in a much lower monthly payment for them and their family. And these challenges can really trip you up along the way through the assumption process, which can make things very stressful. Assumable mortgages are rare compared to the trillions of dollars in new mortgages issued every single year. However, they have been growing in popularity. The FHA and VA handled about 6,400 assumptions last year, more than double the amount in 2022. But with great demand comes great disappointment. Last year, consumers filed 149 complaints about mortgage assumptions with the Consumer Financial Protection Bureau, up substantially from years prior. Some accuse mortgage companies of intentionally delaying the assumption. A realtor survey said that neither himself or his buyer has been able to reach a human being at the servicing company, which would be extremely frustrating. Here's my verdict. A credit score doesn't guarantee a smooth assumption process. You have to assume the seller's financing, and you can't always do that. So don't count on it. If you want to get an assumable mortgage, you may stumble across it, but do not put all of your eggs in one basket. Only a few loans are assumable. When rates come down, you can always look to refinance your mortgage. So if you stumble across an assumable loan, you should be very specific with the terms. After all, you're not getting your own loan, but you're assuming somebody else's loan, and you can assume some pretty bad stuff. If a seller has an assumable loan, many times the listing agent, the realtor representing the seller, will include the assumption information in their listing description. A 3% mortgage sounds like a golden opportunity, but remember, success is not guaranteed. However, staying informed and being prepared for hurdles and maybe some negotiation, you could find yourself amongst the lucky few who are able to manage and secure an assumable mortgage. Too good to pass up. Many buyers use government loans, FHA, VA, and USDA because they allow for a low down payment. An FHA loan requires 3.5% down if VA and USDA require no money down. If the sales price was $600,000, the seller owes $450,000. The biggest hurdle, you need to come up with $150,000 due at close. And the loan has to be assumable, and will the loan servicer be able to complete the transaction within the standard close of escrow? Not very easy. It's kind of like threading a needle, as they say. My advice, always get pre-qualified on your situation and use a reputable lender. If you happen to run across an assumable loan and the terms work out, go for it, but don't count on it in order to buy a home. Knowledge is power, so subscribe to this channel to stay on top of everything mortgage real estate related. And please don't hesitate to reach out to me if you have any specific questions like this, or if you wish to get pre-qualified.